are there any other types of like special characteristics we should think about? Actually, that reminds me, right? Because let's say it's a 5-year bond expiring 2027. The issuers actually get a chance to redeem early. So let's say now they are paying you 6-7% because interest rates are high, right? That's the environment now. Next month the Fed pivots. We go back down to zero interest rate next year, and they want to refi the bond now because that is a high cost of debt. Can they do that? And kind of just pay you out and saying bye bye, I want to get a new bond, I want to get a new set of bondholders?
Yeah, I mean, in this case, if the Fed ever pivots, right? I mean, it came out yesterday that the Fed has decided not to pivot.
Not to be higher for longer, right? Yes.
And if let's say they decide to pivot and next year, interest rates drop, they started to, just fall like a brick. What they can do is that, if they have what you call a call option in the bond itself, they could actually exercise that call option. That means they're able to redeem the bonds back before the maturity date. And they can redeem the bond and they can reissue, reborrow again from investors at a much lower interest rate, because if interest rates drop, they can get they can borrow money at a much cheaper interest.
Yeah, it's cheaper for them.
So this is good. Now there's another special characteristics or special feature of some of these bonds which is also good to pay attention to, is what you call a step up.
Okay.
So a step up is like what you commonly see in our Astria bonds, right? Our Astria retail bonds. Now those have what you call
again
step
a
ups.
product I don't really understand. Look at it, I'm like,
Yeah. So
but anyway.
So what happens is, in order to entice investors, what they do is, say for example, Astria has a 10 years maturity and it could be very, very long for investors. So what they do is that, during, say, on the 5th year, what they could do is Astria could tell investors, say that on your 5th year, they could actually increase the coupon by another, say, 1% or 2%. Okay. So this sort of entice investors to actually buy into a bond which have maybe a very, very long maturity, because investors might not be too comfortable with investing in what you call a long-dated bond, or a bond which has a very, very long time before they get the money back. Right? So they entice investors to actually invest in a bond for the long term, by actually introducing some of these attractive features. Right? They can increase the coupon, on the 5th year. Right?
But is the increase typically kind of mandatory? So it's kind of written in that it will definitely increase, or is it a bit like a cocoa where if I meet certain conditions, or if like I hit ABC, then I increase, if not then I don't increase?
Oh yeah, for sure. So if I remember correctly, for Astria bonds, they will have to increase, or they have to step up the coupon, by a certain amount, and that is something which they have to do. However, they combine it with the call option, where they say that if they don't increase, then they might have to buy back all these bonds. So they will actually sort of have the option to actually redeem all these bonds if they don't increase the coupons.
Yeah, but I mean, if I bought it with the hope of getting more yield in 5 years, I don't want to be bought back, right? I want you to give me more yield.
Yeah. So this is so it's all decided by the issuer, by the company.
Yeah, I think that's kind of the case, right? You are a price taker, essentially.
Yep.
You take the terms of the bonds that are set.
Yeah. I mean, why aren't we all, when we are investing in stocks and bonds?
Well, yeah, I mean, the choice that we make is whether or not we want to buy, right? So in a sense, yes, you take the company as they come. You say yes or no to it. I think it's just I'm just too used to loans, right? Where people actually negotiate these things. So look at it from a retail bond, it's like, this is a bit odd, but it just shows the imbalance of power, I guess. Okay, that sounds good. Other than this.
Yeah, I think one way, as bond investors, how we assess bonds, we don't just want to look at some of these terms or these special characteristics. We also want to know who are these issuers and how do we actually qualify them, such that they are, that they fall into our radar of high quality companies, right? So one way, is to actually look at whether they are actually growing their revenue. So it's a lot like putting on our stock investor thinking hat, where we have to actually look at whether they are able to grow their revenue, whether they have, again, boils down to whether they have a good business model, whether they are able to grow their revenue, whether they have a good products or services to sell. We also want them to be able to generate profits which are able to actually pay the interest, right? We don't want to have a company which is not making money and they have no way of actually paying you any interest, right? So this is something which investors, we have to be looking out for. Of course, at the end of the day, when we own a bond, when you own a bond, we do not participate in the profits of the business, right? So no matter how much the company is making, we don't really have to bother about. What's important here is that we make sure that they have enough profits to more than sufficiently pay for the interest to you. So that's something which we want to be looking at, right? To be looking at some of these little figures here.
Okay, I like all these things about going back to equity investing because I am more comfortable. But let's kind of take a step back, right? So what we are talking about here really are the fundamentals. We think about, again, your view of whether a company can repay you as debt, because you are really as a bondholder, you are really a debt holder. It's really about whether the company can pay you back, and that goes back into all those questions about, are they a good business, and do they have growing revenue, do they have sufficient cash flows, all that, right? That's fine. But then what? And of course, last week we also talked about, oh yeah, we want a brand name sponsor, we want a brand name issuer, because that gives us a certain comfort. We want a high credit rating, because again, that this is all shorthand, right? Essentially for a good business. But what about something like the Astria bonds, right? How do you actually assess the fundamental? Okay, so maybe not really the Astria bonds, but how do we really assess the fundamentals of that, right? Do we again go back to our equity investing, look at PE ratios, look at free cash flow, or do we look at something else?
I think for a bond like Astria, right, because it's owned by a fund, and this fund basically invests in a basket of different smaller private equity funds which invest in smaller businesses. There's really no way
I was like, I
of
know.
identifying these individual companies, right? So you have to actually look at, number one, who the fund manager is, the quality of the fund manager, and whether they have a track record of repaying investors' money, whether they have a track record of being transparent, honest, and are good stewards of what you call money or your capital. So I think that's one way to actually look at it. And more importantly, of course, Astra is also owned by Temasek, right?
Yeah.
Our
So
sovereign wealth
that
fund.
I
So
think that's the ultimate comfort, right? Temasek owes me money. If Temasek cannot repay me, my CPF also gone, everything also gone, never mind lah, just give it to them. Right? I think that I mean, so I think it's maybe a bit of a special case where you don't really have that much fundamentals. I mean, they talk about it being a PE backed bond and all that, but it's actually marketing, right? Because you don't get PE returns, you get bond returns of 4%. But at the end of the day, where you're deriving your comfort from is really Temasek, almost like the Singapore government. Yes, we are different. They are different, we know that, but almost like the Singapore government, so should be very safe. I trust them to pay me my money back.
Yeah.
Because if they don't, like, we think High Flux was a big deal when they defaulted. If Temasek defaults, it's a much bigger deal. Right? So but you're going to a more conventional bond or more conventional company, let's say the new Fraser's months coming up, right? Is there something that we should look at? Like, if we look at, okay, Fraser's again, then should we look at their earnings? What are there any sort of ratios that we can look at to kind of be comfortable that they are going to be in a position to repay us or to repay the bonds?
Yep. So again, it boils down to whether a property developer is able to actually make steady revenues, or growing revenues, whether they have good profits, whether these profits can sufficiently cover, the interest, at least, right, 3 to 4 times. Also, you want to look at what I call the leverage ratio, which is basically taking your total debt of the company divided by the equity of the company, right? So the equity is basically the net worth of the company itself. And
Yes, after taking into account preferred shares, yes.
so typically you don't want to have this ratio go more than 120%. I think going beyond that could actually be a bit more risky, a bit more dangerous. So that's something which I will also pay attention to, because if they are already, at least 120% in terms of their leverage ratio, what this means is that if they're going to borrow more money, it's just going to make it even more risky, because they have to actually service a much higher interest payment. The amount actually goes up, then the ability to actually pay you back, gets even more risky, because they actually have to they owe more people money, right? So that means they actually have to run even faster to make more money, to make more revenues, to actually pay their investors back, their lenders back.
This really sounds like value investing 101.
Oh yeah, it is. I mean, bond investing, it's also about value investing. I mean, in any form of investing, it's important to actually look at the fundamentals of a company or of a business, right? I mean, we don't just want to go in blindly, just buying the financial instrument itself. We want to know what's underlying, what's beneath the surface of all these instruments.
Okay. That all sounds fair. You know, I like this because I know what you're talking about for once.
Oh dear.
But you know, yeah, okay, good. This is good. Easy, you know, shorthand metrics that I just run a spreadsheet, tick tick tick. I can go.